Good morning, everyone. This is Troy Eckard, the founder and chairman of the board of Eckard Enterprises out of Allen, Texas. Today, I have a really fun and unique guest with me, and it's somebody I've gotten to know basically over Zoom over the last year and a half. And I have with me Thomas Castelli, and Thomas is CPA, has a tax planning practice, is also a very successful and well-known podcaster under Real Talk Podcast, TaxSmartREI podcast. And the last 3 or 4 times we've talked, we basically have focused on what I do, which is oil and gas, energy exploration, and all kinds of energy asset investments. But we're going to turn the table on him today. We're going to let him introduce himself, talk about his firm, his podcast, and then I'm going to get to ask him a bunch of tough questions because I can tell you one thing. There's 2 people we don't like, the IRS and our CPAs, and not because they are the same aligned interest, but usually the CPA is the bearer of the bad news when we have to pay that IRS bill. So Tom, glad to have you on board, my friend, and good seeing you again. Why don't you tell this great audience a little bit about yourself and your expertise and kind of let them know who you are.
Absolutely. Thanks for having me today. My name is Thomas Castelli. I'm a CPA and tax strategist for real estate investors across the United States. Our firm, Hall CPA, we work exclusively with real estate investors and business owners. Many of them are high-income earners who are looking to invest in real estate and use the power of the real estate tax code and what's available within that to reduce their tax bills. We also help people streamline their accounting systems and also simplify tax preparation. Both those are also key, but tax strategy and planning, that's really where you discover what moves you can make to ultimately reduce your taxes and influence the results of your tax return when it does come time to file. So me personally, I work with somewhere between 250 to 300 investors one-on-one, and then help many more through the TaxSmartREI podcast and our TaxSmart Insiders community. So it's really been an honor to help so many people, and excited to jump in today.
You know, I love the way you approach it because you talk about it's exciting, and I never find accounting exciting. I never find taxes exciting, but you know, it's like the saying goes, when you're an expert at what you do, you almost take a great pleasure in perfecting what you do and then being able to share that in a beneficial way with others. So if you don't mind, I'd like to just kind of get into it so that way our viewing audience will get some real substance out of this podcast, because quite frankly, I think we've had quite a few that have registered, over a couple of hundred, and I know there's probably another couple of hundred that were anxious to get the recording once we're finished. So Thomas, let's talk about what's probably the hot topic today, which is, in my view, we've got about 2,200 accredited millionaire clients in our firm. And I can tell you the number one question in everybody's mind right now is Harris or Trump, what taxes are going to look like? And I know you don't have a crystal ball, but I'm sure within the tax world, the CPA planning world, there has to be some gathering of data that says, if we go left, this is what we're going to face. If we go right, this is what we're going to face. And I believe the Harris campaign has already made some big claims about additional taxes. And in a short summation, kind of tell me what you think the biggest, most dramatic change would be if a Harris presidency were to take place in the November election.
Yeah, I mean, I think the biggest thing for most people probably listening here, accredited investors, would be the expiration of the Tax Cuts and Jobs Act that was put in place under Trump during his term back in 2016. And within the Tax Cuts and Jobs Act, you have bonus depreciation, which is phasing out right now. It's currently 60% in the year 2024. And it's going to decrease to 40% in 2025, and then in 2026 it'll be 20%, and then it's eliminated. So the Harris administration, as well as Biden and pretty much the Democratic Party, want to see that phased out. I want to see that expire. So we would not see 100%. We would not see bonus depreciation come back. We would not see the QBI deduction, the qualified business income deduction, that 20% deduction for business owners. That would also phase out. Tax rates. The highest tax rate would go back to 39%, 39.6%, I believe it is at the top end. That would occur. And then on top of that, just some of the other provisions in there that we'd want to see extended. For example, qualified opportunity funds, that would most likely be put left where it is now. So overall, that I think is probably the biggest changes that we see for real estate investors and like small business owners. There's some other things in there, but those would be the primary things. And just want to give everybody a quick update. I know a lot of people ask me this question: will 100% bonus depreciation come back retroactively? That was discussed in a bipartisan bill. That bill was shot down by the Senate a few weeks ago. So 100% bonus depreciation will not be coming back retroactively for 2023 through 2025, as some people have hoped. But yeah, the expiration of that with 100% bonus depreciation probably being the biggest one is what is the biggest thing I expect to change in the Harris administration. She also wants to increase corporate tax rates. I think 28% is what they kind of landed on. And whereas Trump wants to decrease them further, it's currently, I believe it's 21% right now. He wants to decrease to 15%, where again, they want to go to 28%. So that's a big one. They also, Harris has also supported limiting the 1031 exchange, which I know is a powerful vehicle for a lot of real estate investors, and even in the oil and gas industry. They want to limit it to a maximum gain of 500,000 if you're single. So that's the max that could be deferred. If you're married, that would be $1 million. So that would be something that they've supported. They also want to potentially tax depreciation recapture, the amount that's currently taxed up to a rate of 25%. They'd want to tax that at ordinary income rates, so whatever your tax rate is. It's something they've discussed. And then also carried interests. So for syndicators and funds, if you're a GP on one of those, a general partner, or you're the sponsor, they do want to eliminate carried interest. And carried interest is the ability when you get that promote, say that 20%, like if you invest in a syndicated fund, usually what happens is, 70% or 80% of the profits go to investors, 20 to 30% goes to the sponsors. Those are typically taxed at a long-term capital gains rates. And they want to eliminate that. They want that taxed at ordinary income rates, which are generally higher for most people who are in that type of business. So those are just some of the things that you might be expecting from a Harris campaign. Trying to think if there's anything else that they mentioned that would be worthy of note. They do want to have, she has supported or proposed doing a 4% tax, a Medicare tax, Medicare for all on folks making over $100,000, which we believe was a pretty low threshold for a tax increase like that. But something else that she's mentioned that she supported. So those are just a few of the key highlights that you could expect from a Harris administration, or at least what they support.
Well, let me summarize. Yeah, let me summarize it from my take. Much higher taxes if Harris gets in office, massive deductions and available tax tools to manage your tax bill. And it looks like whether it's corporate, capital gains, carried interest, whether it has to do with individual tax rates, it's all going to be higher. So in my view, in what you said, I'm going to make money either top down or bottom up. I'm either going to grow my income or I'm going to cut my cost. But if I'm going to have to grow my business and give away more of it, I'm probably going to be less inclined to want to grow my business and take those. That's kind of the deciding factor for a lot of businesses is going to be depending on who wins office, what those taxes look like as far as motivation for further growth in business and investments, et cetera. When you think about the Trump side, he says he's going to cut taxes. And I find that a little bit difficult to believe, but you're the expert. Because when I think about a $35 trillion debt, you really have to bottom up the economy. We've got to create more income off of more growth in the economy. The economy seems to be faltering. So, how are we going to cut taxes when we're already $35 trillion in debt and our value of our dollar seems to be weakening? So what are your thoughts about if Trump gets in? I mean, he had a great tax plan in 2017, but I doubt he's going to control the House and the Senate, and I doubt he's going to get much passed. And if he does midterms, they might unwind it. So what are your thoughts on Trump? What could he do at this point in stage to cut those taxes?
Yeah, so he's actually been surprisingly light on the tax plans for for this cycle. He hasn't mentioned too much, but you could look at what he supported in the past, and you look at the Tax Cuts and Jobs Act, and if he were to get into office and we're able to get anything passed, then it would probably be an extension and perhaps even an expansion of the Tax Cuts and Jobs Act. So you could probably expect bonus depreciation to come back, QBI to stay intact. I think he wanted to make the lifetime gift and estate tax exclusion permanent. It's currently set to phase out and go back to $5 million, I believe in 2025 or 2026. But those are probably what you could expect from him. I know he's mentioned no tax on Social Security, something he's campaigning on. No taxes on tips is something also he's campaigning on. So he does want to cut taxes. And I think that's the way that he would do it. Again, I think the primary thing would be the extension and expansion of the Tax Cuts and Jobs Act. But in terms of the ability to generate revenue, I think his philosophy is he would use tariffs as a way to generate revenues for the tax revenues essentially, or to mitigate or to pay for his tax cuts. That, however, from the research I've performed, would need to be pretty steep and expansive to cover that gap. So I don't know if that's going to be able to cover the entire amount that would need to be made up for tax cuts, but something that he's definitely supported in the past and probably continues to support tariffs. And I think his philosophy is the lower the corporate tax rate, the lower taxes on small businesses, the more jobs that would be created, the more opportunity would be created. And through those jobs, the taxes that are incurred in those jobs, things like that, the income taxes that those workers would pay, et cetera, that would help make up for the difference in the make up for that gap. At least that's what I'm seeing. But I haven't had many concrete plans heard many concrete plans from Trump for this current cycle.
Yeah, I've not heard much in the way of details either. By the way, I noticed that we're picking up some chat and questions at the bottom for those that are in listening and paying attention to what we're talking about, which everybody should be. If you have specific questions, either to the content of what we're discussing or something you might want us to try to touch on before the hour is up, let us know, so that way we can definitely try to address those. We've got Derek Long in the background that'll help funnel and feed questions to us. So when I think about the last, I don't know, call it 7 years since the 2017 Tax Act went into place, there was a tremendous amount of growth in the manufacturing, fabrication, and really anything that had to do with tangible assets, because you had such a big bonus depreciation and tax write-off. I mean, you had 100% write-off in my industry, which was oil and gas exploration. Do you see from either side any concern about future tax deductions for drilling wells, or the 15% depletion allowance for either mineral rights or working interest? Or do you think both are kind of like leaving those as we can't really touch them because it helps provide low cost energy for the country? Or have you heard any rhetoric from either side about how they might address the oil and gas industry?
Yeah, I have not heard anything specific from either side. There's a lot of documentation stuff to sort through. We're still going through it and keeping up to date as things go on, but I've not heard of anything. As far as oil and gas is concerned, specifically for the working interests, those have been around in the tax code for a very long time. I don't expect that to change at all, and I've not heard of anything specific to change the way that working interests are taxed. As for depletion allowances, I've not heard anything on that end either. I don't know that they would take that away at this point. That's a pretty what I'd consider a standard deduction, not the standard deduction, but a pretty common deduction. I don't think that they take that away. And I'm not seeing anything right now. I think the biggest thing affecting oil and gas industry would be for people who have working interests. They hold a working interest. If they do have any income that's generated on that positive income, they may not be able to. They won't have QBI deduction anymore for that. I don't know how extensive that is for many in the oil and gas space, but the QBI deduction would be phased out with the Tax Cuts and Jobs Act. And on top of that, like you mentioned, bonus depreciation, if that's phased out, that may impact some of the initial deductions that are taken in those early years or in the first year. So those are the two biggest impacts that I'm seeing.
Yeah, I love your comment too. I always like to read between the lines. You said, if you make any income from your drilling, you'll have to figure out how you're going to handle the tax on that, because quite frankly, it's a very precarious business. And most folks that invest in oil and gas find themselves with complete failed investments, dry holes, et cetera. So the new regime, the new reality is with horizontal drilling, you're hitting virtually 100% of your wells. If you're not over promoted, you're going to make money. And the income is now something you really have to look at, because you got to figure out how that income is going to be treated. When that income comes in, it'll be added to your normal federal tax liability on your ordinary income. So if you're successful, you just created another income source, and that's creating more tax issues and goes into your overall tax planning, which is why somebody like Thomas Castelli and his firm are so critical, because as we shift as investors, we have to tell our professional CPAs, hey, I'm doing this, I'm investing in that, this is the consequences. And then they've got to look at the tax code and forward plan for success or failure, or forward plan for how they're going to manage those taxes. My CPA does not like me walking in April the 14th and saying, by the way, I forgot to tell you about all these investments I made last year and we need to treat them. They're like, what? Okay. couple other questions I want for you. Now, this gets to more what I'm hearing from some of my partners, and I want you to go slow, and I want you to answer this because it's a little tricky. I hear from my clients continually, how do I find a good CPA? So the premise says, I have a CPA, I'm using a CPA. In my own assessment as the consumer who's hired a CPA firm, feels like they've let me down. Did they let me down in that they weren't responsive? Did they let me down in that they didn't understand the tax code? Were they more reactive instead of proactive, not planning? Or did I get hit with this bigger tax bill than they told me and it was unsuspecting and they should have known better? Or they missed tax write-offs last year and I'm getting hit for taxes I didn't think I owed? Or is it just personality? But that is a big thing I've been hearing since January 1st of this year is, do you know of a good CPA firm that is more in tune with alternative investments and oil and gas and really understands what's going on because of all these different syndications? And I'm like, to be candid with you, Thomas, it's really, really difficult to find a CPA firm. You go, that firm is the firm I'd go to. Because if it's true, then you, like you said, you have 250 to 300 clients. You're like, how do you add another 100 clients? I mean,
Right.
the bigger you grow, the bigger your client base, the more complex the return, less hours in a day. So that's a big pile of questions I just dumped on you. Let's see if you can handle, like, how do I pick a CPA? What do you think is going on in the market? And what's your thoughts?
Yeah, absolutely. So let me start here. So most CPAs out there are generalists. And what does that mean? That means that they don't really specialize in one particular industry or one particular type of client. They kind of take whatever comes their way. And because of that, they never really dive deep in any specific area. They don't dive deep into how, for example, the real estate tax code works. They don't dive deep into how oil and gas works. They don't dive deep into really any one vertical area, I guess you could say, to really kind of learn and understand all the advantages that one area has to do. So that's kind of the first problem. If you just go to your CPA down the block or your typical CPA, you're going to be working with a generalist who may not be an expert in your specific type of business, so the type of investments that you're investing in, especially alternative assets like real estate and oil and gas and others and other types of alternatives. They don't really understand that area. That's kind of the first thing. The second thing I'd say on that is, additionally, most CPAs that deal with tax, most tax professionals are tax preparers, and that's different from a tax strategist. So a tax preparer will file your tax return in compliance with the Internal Revenue Code regulations and IRS publications procedures to make sure everything's being filed correctly. And that's critical. It's really important that happens. That cannot be discounted. However, because of this, they often do not give tax advice. They're looking backwards. What happened last year? How can we fill out this form for you the correct way? So they don't often give tax advice. So they might not tell you proactively, hey, if you do this, you do that, you can actually impact your outcome. They don't do it after the fact. So it's not like to tell you, hey, last year you paid XYZ taxes. Next year you could actually minimizing it by doing ABC. They don't do that. They don't tell you, hey, let's meet in the beginning of the year. Let's meet midway through the year. Let's meet a few times so that I have an understanding of what you're doing so that I can proactively advise you on what to do. And the reason why they don't do that is a function of a few different things. The first thing is it's simply just not their business model. Their business model is to do as many tax returns as possible and get them out the door. So they're often too busy to actually be able to proactively advise you because they're just too busy doing tax returns. That's the one reason.
They've got, what you're saying is they've got like an assembly line process, which is to take the data from the client, process it, match it to the IRS code, and get it filed on time. And so that's not somebody who's acting like a consultant or strategist. They're simply being the reactionary professional preparer to make sure it's done correctly and on time. And I think that's not what this crowd watching you and I on this podcast are looking for. I think Derek and I were talking, this is pretty much about 85+% accredited investors. And I don't know about anybody else on the show. I don't think I've ever filed a tax return since I was 21 years old before October 15th. I got partnerships and syndications. And so I don't even look at April 15th other than a deadline for paying the estimated tax. But realistically, because you're successful, you have to have a tax professional, not only that can prepare it correctly, but they've got to look at what you're doing, how that fits, carry forward, all that kind of stuff. And then at the end of the summation, like you said, have a meeting to go, okay, this is what you did to yourself last year. Here's some ways we can improve that, increase tax write-offs. Let's don't do that particular investment. It wasn't in your benefit. So I think what I would say is, summarizing what you're talking about, is you got to find the right professional for your situation. If you're a standard tax-paying American, well, then you need a generalist because it's generally going to do everything. You might have that one outlier, not a big deal. They're still going to file it correctly for you. But a tax strategist, which is what I believe your firm is you're saying, let's look at what you did the last 2 years. Let's look at what you filed. Let's look at what you invested in, how you've diversified your business practice, your investments. Let's figure out what kind of bundle you have and create a plan forward for that taxes. And that's kind of what I'm leaning toward for my investors is if you're a tax strategist, you're like one of the very few professionals. So how in the heck do we get on your list to get your attention when I become your 251st client? And that's what a lot of my clients saying is, I can't get on anybody's list. I can't get them to return my call. They're too busy. And I think there's a shortage of CPAs, isn't there? It seems like there's a shortage of CPAs out there that are not just tax preparers because, man, it's hard to find tax strategists these days.
Yeah, no, absolutely. There's a shortage of CPAs out there in the industry in general. But when it comes to tax strategists, what it comes down to is this, because I know you mentioned communication, which is absolutely key. So when we are advising people, to your point, what you mentioned before, we're looking at what someone's situation is, what they have currently, what are they doing in the past, and also what are they doing this year, what are they doing next year, what are they doing the next 3 years, what are they doing long term, and how can we help them plan for that? Within that, communication is absolutely essential. So while most CPAs are too busy to respond to you, the reason why it takes your CPA a week, 2 weeks, 3 weeks to get back to you on an email is because their head's down doing the tax returns. So what we've done at our firm is we have a dedicated team of tax advisors where what they do is they work with clients on a one-on-one basis, and they help advise them on what they need to do to minimize their taxes. Again, not only what they currently have, but what they're looking to do going forward. And within that, not only do our clients have the ability to get on phone calls and schedule, consultations with their advisor, but they also have email support. And we've made it a point in our firm to respond to emails within 24 to 48 business hours, sometimes less. And the reason for that is not only because it's effective in advising clients, sometimes who are moving rapidly, but also because we recognize that there is this gap in communication in this world of in the CPA world, where people just do not respond to their clients. So we take that proactive communication very seriously, and we don't play around with that. So that's something that we solve for. We want to be an available resource for our clients. Now, as for kind of getting on a list or kind of working with a firm like ours, if you go to therealstatecpa.com, we have an email training you could jump on to learn more. Or you could, request a consultation with our team. Be more than happy to have a free discovery call, see if we can help. But that kind of in a nutshell, I think answers your question.
Yeah, it did. I'm looking at a couple of questions that are popping up, and I'm assuming that a good portion of the participants viewing this are probably investors of Eckard's. I didn't look at the participation list, so I'm getting a couple of oil and gas questions, and I don't want to get into the nitty gritty, but let's just talk about the 2 or 3 things that are always popping up for oil and gas investors. Number one, there's a little bit of a difference in how participation and working interest is treated versus, let's say, mineral rights. Mineral rights are pretty simple. It's 1099 income. It comes in, you got a gross check. You take the 15% depletion allowance. That's what you've got, right? That's not a difficult one to think about. When it comes to working interest, though, the question that was asked by one of the participants is it subject to FICA? Is there any kind of treatment differently than ordinary income tax when you have income off of working interest? And how is there anything particular that the listeners should know about working interest income versus, let's say, mineral rights income or royalty income?
Yeah, so
to the best of your knowledge.
Yeah. So working interest income, that is typically going to be subject to the self-employment tax, which is FICA. So FICA and, basically Social Security, Medicare. If you have a job, you typically pay 7.65% of that. Your employer pays the other 7.65%. When you're self-employed or you're involved in something that generates self-employment income, you're going to pay 15.3% up to the threshold, which I believe is like 160 I think it's like 163,500 this year, but you pay that amount, and then after that, you just pay the Medicare portion, which is 2.9%. So that does come through on a working interest, and that's because the working interest is considered non-passive, whereas the mineral rights are also considered non-passive, but it's not. But royalties are not subject to that tax. Right, it's the royalties that are not subject to it. The working interest
Yeah.
is.
Yeah, the royalty is just straight up income. You have no control over it. So it's distributable income, almost like a dividend, whereas the working interest is like owning a business. You're participating actively, taking deductions, getting write-offs, and participating. I think the one thing that maybe the participants ought to realize is that, you have these phase outs like on the self-employment tax up to whatever it is, 163,000. But in that same 163,000, you're getting 15% of your income. You don't pay taxes on them. They kind of wash each other out.
Yeah.
So what they've done is they've kind of figured out how to get back their 15% by charging you the self-employment tax. It kind of is a wash. But after the 163,000, now you're just paying the Medicare tax and you have the 15% tax-free depletion. So, let's face it. I think everybody on this podcast or on this particular interview needs to understand one thing. The federal government looks at anybody making over $200,000 a year as being an elite income earner in this country. And it's moved up slightly, but let's just face it. So their job with the IRS is to challenge tax professionals and strategists in figuring out how they can get more tax dollars out of us. They give us tools to use. They give us tax deductions. They give us policies, IRS code. And we have to figure out how to navigate that, which is very difficult as an individual investor. So I think hiring a strategist is incredibly important. One of our viewers did ask, though, Thomas, a lot of CPAs tout themselves as strategists. And so normally you can do a background check on lawyers and CPAs and doctors and see if they've had lawsuits. What's the best advice you could give this viewing audience about how do you really know you have a strategist versus somebody pretending to dress up like a strategist? What would be the clues or the keys you would say you should look for?
Yeah, I would say the number one thing. Okay, the number one thing is probably displaying subject matter expertise via social media, podcasts, YouTube videos. If you're a tax strategist, most of them that I'm aware of want to display that out there, and they'll get out there, they'll do the podcast, they'll do stuff like this. They'll go out there and actually tell people how they can reduce their taxes. So I think being able to find people who put out content on that, especially on a regular basis, and who can display their subject matter expertise, display the fact that they're a tax strategist before you start working with them in that sense, is probably the biggest one, right? That's can they walk the walk, or are they just telling you on a sales call that they're a tax strategist? That's probably the biggest telltale sign. Another thing would be when you do they have tax strategist or tax advisor in their title? That's not always a telltale sign, but if many of them want to kind of project that, that's something you want to question. If you get on a sales call with them, or you get on an onboarding call, whatever the case is, a client consultation, discovery call, you want to see, are they talking more about tax preparation? Are they more focused on how they can help you file your tax return, or are they speaking with you? Are they talking to you about how they can help you reduce taxes with tax strategy and planning? So I think that the biggest one by far has to be the content. Then followed by, when you get on a call with them, what are they, during that initial exploration process, what are they focused on? Are they focused on how can they help you reduce taxes today into the future, or are they just simply focused on how can they help you file your tax return? Those are the two biggest ones. Now, unfortunately, this one, then actually, I didn't even go as far as to say you want to get testimonials and case studies from the tax strategist, because at the end of the day, if they're a good tax strategist, if they're worth their weight in gold, if they're worth anything, if they're worth what they're saying, they're going to have testimonials from clients who are going to basically have stories about the experience they had with the firm. I know that we have hundreds, we have at least 100 testimonials with clients that we work with where they're saying, how we help them from the advisory process, how much money we help them save on taxes, things like that. That's evidence that they're actually a tax strategist, their client testimonials. And if they have case studies, for example, there's case studies where we're able to show people, hey, this is making up a name here, but this is John. This is before he worked with us. This is after he worked with us. How much money did he save him? What strategies did we use? That those types of things just prove that they're attached. It's proof, right? and it's not just what they're saying. So I'd say, again, just to summarize that, that's not to beat a dead horse. Content marketing, are they out there doing podcasts, webinars, YouTube videos, displaying, do they have books? Are they displaying their expertise outwardly? Then when you get on a phone call with them, are they looking to help you simplify your taxes? Or are they trying to help you reduce your taxes through proactive tax strategy and planning? And then the third one, testimonials and case studies that show evidence of the clients that they've helped.
Yeah, so I would summarize what you said as the following. Do your due diligence, just like investing with a multifamily sponsor, just like you're investing with oil and gas. Who are they? How long have they been doing it? Do they have clients, a track record, references, which is your testimonial part? And do they have a level of expertise? I mean, I look at many of the sponsors that have been out the last 6 or 7 years, of which most are failing, and they were a mechanic. All of a sudden, they're a multifamily expert. They were selling Cutco knives. Now they're a mastermind telling you what to invest in. And so the problem is that if you don't look at the substance of the career, the resume, the antecedents of that professional CPA saying they're a strategist, and you can't get comfortable, they can talk about complex, non-generalist items and subjects, you've got a problem. That's not really a strategist. That's somebody who's putting on a strategist t-shirt, and they're trying to get a certain level of respect that's not earned because they haven't proven it by virtue of what their historical tax preparation, tax strategy, client maintenance has done for them. Couple of questions that we're getting on the side, and this is from Jay. We got some questions from Jay. We've got some questions from Shad, but it's all about Eckard. So I'm just going to go ahead and knock it out and get out of the park. So this is how I've always looked at it. Each CPA I've worked with, which I've worked with hundreds over the last 40 years, all kind of have a different interpretation of the tax law, right? And what it really boils down to is the approach that each investor takes. So for example, in working interest, and according to the 1986 Tax Reform Act, you have to be an active participant. You have to have joint and several liability. Your money has to be at risk. You have to be in a position that you're still active, at least for a period of 12 months. And then some sponsors like to strategize by flipping you to a limited partnership role to limit your risk beyond that first 12 months, et cetera, et cetera. So you can go look at the tax rules and all the tax obligations. But again, it's always going to be a subjective content of interpretation based on the strategist or the tax preparer that you talk to. The questions that Jay and Shad are asking is, when you invest in working interest, do you need to be as an individual, or could you be a single member LLC? And if you're in an LLC, the single member, are you really at risk? And if you start off as a general partner and then you flip to a limited partner, does that reduce your tax liability or your tax advantage? Thomas, I always tell my clients, it's not a tax deduction, it's a tax deferment. And that always throws them off. They're like, what does that mean? Well, I'm getting a deduction this year, but I want to make money. If my wells are going to make money, I've really just deferred the taxes I owe today by taking the deduction this year, but I expect to pay taxes next. I am deducting it, but I should be thinking about it as deferment because I want to make successful wells. The only way I truly get a deduction is I got to lose money. It's an expense. So if I don't plan on making money, it's a deduction. So I guess my question to you is, how would you answer that question from the standpoint of how you need to take ownership in working interest, and then maybe how you see it as, these aggressive first-year tax write-offs, deductions versus revisiting the income that's generated from those wells going forward?
How do I look at it? How do I look at like the deferment aspect of it? So whenever we're dealing with deferment of taxes, the way I look at it is this, right? You always want to look at the time value of money. The time value of money states that $1 today is worth more than $1 tomorrow. That's because of inflation and the fact that you can actually earn a return on your investment. So whenever you have the chance to defer taxes, it usually makes sense to do so. There's certainly some instances where you may not want to do that, or it may not fit into your broader picture. But for when it comes specifically to investing, you want to go ahead and defer that. So that's the way you want to look at it. If you're looking at deferring taxes, look at it as you're going to have this money today that you would have otherwise paid the IRS that you're not going to get back. So once you pay it to the IRS, you're not getting it back. But instead, you take that money back today and you invest it and to earn a return on your investment. A quick example of what that looks like, and I'm going to use ballpark numbers here. But let's say that you had $100,000, right? That you were able to, in taxes, you would have had to pay the IRS unless you deferred it. So now you take this $100,000, you reinvest it at an 8% return, which I think we could all agree is probably pretty low. for most alternative investments. But just say 8% just to be conservative. If in 10 years compounded, that $100,000 would be compounded to $215,000 roughly. So that's $115,000 that you did not have before. So that's the best way to look at deferment of taxes, is you're able to take the money that you would have paid the IRS and generate a return, hopefully in excess of what you would have of the taxes you deferred to pay back. No, what I'm trying to say is the taxes that you later have to pay back from deferring it. But there's ways to mitigate taxes on those deferments, right? Especially with capital gains, when you're dealing with real estate, which is oil and gas and mineral rights. You could use a 1031 exchange. So we have a lot of investors who come to us and say, hey, Tom, well, great, I could take this deduction today, right? I could defer this taxes today, take my money, can go reinvest it. But eventually I don't have to pay Uncle Sam for those deferred taxes. And there's ways to mitigate that. One of the main ways is a 1031 exchange. You can basically, when you sell a property, you sell an interest in real estate that's held for investment. You could take that, defer it into the future, and use the proceeds to buy a bigger or better property or buy multiple properties. So that's one way to minimize taxes on the deferment. There's also a bunch of other strategies that you can use to defer taxes on the sale of assets, things like capital offsetting of capital losses, things like the lazy 1031 exchanges, where you use passive losses to offset capital gains from passive investments. But those actually don't apply to working interests, unfortunately. But those are just the way. The bottom line, what I'm trying to say is, when you look at deferment of taxes, you're deferring taxes that you would have paid today, so you could take that money, reinvest it back into your business, back into alternative investments like oil and gas, so on and so forth.
Yeah, and that's doing for 40 years. So if I've got $1 million income this year, I want to invest as much as I can of that $1 million, other than what I need to live on, if that's what my case is. I want to put it in working interest, take this year's available tax write-off. Depending on how the working interest is structured, you should be looking at 70 to 85%. Your initial investment is going to be tied to intangibles, the drilling, the labor, and you can deduct it. You'll do depletion allowance on the leasehold. You'll do depreciation on the equipment. But I also, and I think this is key, is I expect to make a good well. So I'm expecting income to start in 9 months, and I'm going to make income starting in 2025 and forward. So I will be having new income resulting from this investment I make in 2024, should increase my income in 25, 26, and 27. So I have a higher taxable income. And I think from a strategy position, I must have gone to your school 40 years ago, because my whole idea is I do better with my own money than the IRS does. That's a 100% loss of capital. So I've always taken my tax dollars, reinvested it myself, increased my net worth, and deferred the taxes by pushing those tax liabilities as the income comes over incremental next 5 or 6 years or whatever it is. One of the questions I would ask is, when you think about the current status, if there was any reasonable expectation that the Harris administration might go after intangible deductions, which was mentioned early on in the Biden administration, could you overinvest in 2024, get more write-offs than you need, and push those losses forward? Is that possible?
That is a great question. The short answer to that question is yes. So let's say that you were concerned that could happen. What you could do is make overinvest this year, quote unquote, right? Invest more than maybe you would. And what's going to happen is those intangible drilling costs will come through to you via the K-1 and onto your tax return. And if they exceed your taxable income, meaning they get you to zero, you'd have what's called a net operating loss, or an NOL, as they call it. The net operating loss would be carried forward to next year. So 2025, in this example, if this happened in 2024, and that net operating loss would be able to offset your income in 2025. And presuming it actually can't get it to zero, the way net operating losses work in the second year, but whatever you don't use will just continue to be carried forward. But to answer your question, yes, it's possible to do that. Now, one thing I will say, though, about proposed tax laws is that you have to be careful, because Biden had originally wanted to do the Build Back Better Act. I don't know if anybody remembers that, but it never got passed into law. And one of the things in that was he was talking about eliminating the 1031 exchange, which has been on the chopping block for many, many times. And I talked to a lot of 1031 exchange specialists, and long story short, it just that rarely ever comes to fruition. But what I'm referring to is not the 1031 exchange, just proposals sometimes don't make it into law. And sometimes what we see is people making decisions based off proposed bills that never come to fruition. Like, for example, when the Build Back Better Act was supposed to be passed and, potentially eliminate 1031 exchanges, we've had a bunch of people going and selling their properties, like just based off that. And later to find that never came to fruition. So just I would be careful with that. But to answer your question, yes, if you overinvest this year or invest a lot this year and you have a net operating loss, it can help you next year and in future years as well, potentially.
Yeah, if you have extra cash, you can do that. It's maybe a what if or maybe a preparation for some tax changes going on. There was a couple of questions that were asked in the chat room or the Q&A that I'll need to answer. One of the questions is, can you do a 1031 into working interest? The answer is yes, but I wouldn't do it. The idea of a 1031 is you're taking a successful real estate investment or a like-kind exchange, you're building up profit, you're trying to avoid the capital gains by reinvesting it in a 1031 exchange. I don't really care to put a 1031 exchange into a depleting asset. So if I take my office building I sold, I made a profit, I roll it into working interest, the income and the oil and gas production from that single wellbore is depleting. So I'm going to take taxes, I'm going to put it in 1031 working interest in a depleting asset. That doesn't make a lot of sense. I wouldn't do it. 1031 into minerals makes total sense, right? The other question was, can you take losses now, but would that subject you to maybe losing those tax write-offs, if you carry them out further? Well, first off, I believe the IRS code says that if your capital invested for working interest for tax consideration in 2024, there has to be a meaningful activity commenced on or before March 15th the following tax year. So if I invest this year, whatever wells I'm in or drilling I'm in has to commence by March the 15th. So the only way you could do a tax carry forward is invest in wells that are going to be drilled and activation started by March 15th. You just don't need all the losses, and so your CPA will carry that forward for you. But just keep in mind, the IRS is very generous about giving us write-offs for discovering oil and gas in the U.S., but they want you to put your money to work, and they want the activity to start by March the 15th, and they want to make sure you're not drilling wells with fictitious numbers like they did in the early 80s, where they were getting 3 and 4 times write-offs, and all of that was disallowed, and they came back and had penalties and interest against people that were taking excessive tax write-offs, right? I think the same thing would apply to turnkey contracts. One of the things to keep in mind, you guys are asking a lot of great oil and gas questions. This is not the content for this particular podcast, so I'm not going to try to keep digging too far into oil and gas. I think that's not fair to Thomas. I think the reason is that I got a couple more questions I think are more broad about just general accounting and purposes. So let's just talk about what you've seen in your career between the different administrations, and that every 4 years we're kind of given a new set of rules. So let's say 1031 exchanges are in place. I'm making a bunch of real estate investments. Let's just say the new administration gets rid of 1031. I better be willing to live with the real estate that I bought, knowing that the 1031 may go away, and I may have to figure out the tax implication if I do sell it, and I'll have to weigh the selling against the market potential of an increased value or decreased value in that piece of real estate versus paying the taxes. And I think that's one thing that most people don't consider is we basically are given a set of rules for 4 years. And truthfully, it's every 2 years, because if you have a midterm change in the House and the Senate, they can come up with their own new tax rules and regulations and override the president. So we really get about 24 months of at least rules we know of, subject to alterations and changes. So how would you, as a tax strategist, when you're talking to investors, like, hey, I'm going to buy this real estate, I'm going to do some cost allocation adjustments, I'm going to do some oil and gas, but we're really only given 4 years. How would you talk about that as a strategist, about how we should be thinking about owning assets and making investments, knowing that the rules do change so frequently?
Yeah, so we have a saying at our firms called "Don't let the tax tail wag the dog." And that means basically you want to make solid investment decisions, and look at the tax benefits of your investment decisions as what's the best way to say this? As icing on the cake, if you will, right? Like, I'm not going to go buy in the context of real estate, right? If there's a single family house I'm looking to invest in and it has fantastic tax benefits, but without the tax benefit, the deal makes no sense, and I would not buy that deal without the tax benefits, then chances are you should probably not buy that deal. Like evaluate investments based on the investment parameters. Like if you want to buy, if you want to make an investment, could you live with it? To your point, could you live with this asset without these tax benefits, right? So if your only exit strategy for a piece of real estate is this only makes sense for me if I can exit with a 1031 exchange, if I can't exit with a 1031 exchange, or it only makes sense if I have bonus depreciation, then chances are the investment itself does not make sense at the fundamental investment level. So whenever we're working with clients, we strongly advise them, don't put too much weight or don't overweight the tax benefits of any specific investment. At the end of the day, like, I don't want to sound like a broken record, but at the end of the day, if you would not invest in that, if you would not make that investment without the tax benefits, then you might not want to always make that investment, because to your point, things could change.
I think that holds very true across all alternative assets. As we watch the different sponsors failing, Ponzi schemes, failures, bad management, capital calls, exposure, debt that can't be refinanced because the lending environment has changed dramatically the last 24 months. And so now people are looking at it saying, well, I never would have bought that based on the tax benefit if I knew that the asset itself couldn't maintain a growth perspective. And so, and we all learn our lessons, but I think that the idea with a tax strategist is you need to ask them before you jump out of the plane. You can't ask for a parachute once you're already heading out of the plane without a parachute on. So from a tax strategy point of view, I would think, this is what I do. I would go to my CPA, my strategist, and say, hey, look, somebody's trying to sell me a conservation easement. Somebody's trying to sell me work in there. Somebody's trying to sell me depreciation bonuses on this, that, or the other. I'd want to sit down with my strategist and have that strategist look at how that fits my overall income, my overall tax filing. And then the question should be jointly between the strategist and your own decision is, if that rule goes away or my situation changes, do I want to keep that asset? Am I glad I got in the asset? That's why when it comes to working interest, I tell people, I know there's tax deductions. I get just as many tax deductions for a dry hole as I do a successful well. So forget the tax deductions, focus on the income, because you get the deductions either way. I think the same thing applies to real estate and all other kind of asset classes, which is stick with the fundamentals. It's the who, the right sponsor. It's the what is it? Are you really suited for that asset class? Does it fit you or not? And you need to find out, is it viable? Does it make common sense through your due diligence? It's going to work. Your CPA, Thomas's firm, has tax preparers. They're going to report the carnage you got yourself into. They would much rather, as a strategist, have you tell them what you're going to do, and they might keep you from falling off the cliff or getting stuck in a ditch.
Right.
And I think, and I can see quite a few of the names I recognize on participants, right? We as wealthy investors, we as type A doctors, lawyers, Indians, farmers, ranchers, the whole nine yards, right? We are always thinking we're the smartest people in the room because we're self-sufficient. Well, I learned a long time ago, I'm not that smart with taxes. So I go straight to a professional like Thomas and say, here's what I'm about to do. And he goes, yeah, I wouldn't do that. And here's why. Oh, God, I didn't think about that. I learned a long time ago back in the 90s, it is much easier to pay the right amount of money for a good lawyer, a good CPA, a good strategist. The money you pay your professionals is nothing compared to the millions you lose in bad decisions. I learned that the hard way. And after I learned that lesson, I hired the best CPA. I hired the best lawyer, and I don't care what they charge because they're going to save me 10 times that in making the right decisions, which leads me to the next question, Thomas, for you. There's a CPA firm that I've kind of used as a referral for some of my investors here in the last month. And one of the things they said is we have the bandwidth. We can handle new clients. And you know how it is that every firm tries to manage their costs. They have personnel on their team that do certain things. But let's just say, for example, we've got 200 people registered to this call. And they all said, we love Thomas. We all want to go to Thomas's firm today. You obviously have a certain bandwidth and some constraints in how you onboard people, what you can take. What should a potential new client for your firm be thinking when they call your office and say, hey, I loved your podcast with Troy. I'd like to move my accounting business to you. Talk to us about how that would happen. And do you have the bandwidth? And if not, how you would address this onslaught of potentially 200 brand new listeners who just loved your show today.
Yeah, no, absolutely. No, thanks for the question. So within that, the first thing we do is we hold a discovery call with every single person who, first thing you would do is you would go to our website, you fill out a form. After that, we would reach out to you with next steps, typically going to be booking a discovery call where we learn a little bit more about you and your situation and determine if there's a fit to work together. If we agree there's a fit and you join up on the firm, we do have a wait list, and we've had a wait list for a while. It's not too long of a wait list. Currently, we're scheduling people out for September to start working with an advisor. So that's how we make sure we don't overwhelm our team. We have a wait list for that. Secondly, because we've gotten to the point in the industry where we're pretty well known among CPAs, we have people who really want to work for our firm. So while there is a shortage of CPAs out there, in the general marketplace for hire, because of our position, we're able to bring on some of the best people in the industry. So when we do need someone, we do hire for that, and the wait list helps us make sure that we have enough time to hire people when that is necessary. And when we do hire people, we look for people who are experienced. Not that we expect them always to hit the ground running, although that's always great when that does happen. But we also have an excellent training program where we put everybody through a training program from the technical aspects of what they need to know. So the tax strategies, the tax code, and all the other things that are related to that. But then they also go through an intensive training where they shadow one of our current advisors and basically get to understand how to learn the ropes. So that's how we manage capacity. We have the wait list and we're able to hire people relatively quickly. So if there was 200 people who wanted to work with us today, as fantastic as that would be, we'd most likely have some people on a wait list, and that would allow us to onboard new people if it is necessary, to basically have everybody in place. So
do you have a psychologist on board to evaluate your new onboarded clients and decide which ones are going to be the pain in the neck and overly demanding? And I know that's in my practice, Thomas. I'll have partners that'll join and instantaneously they'll make an investment. Next thing you know, they're asking 1,000 questions. They want answers from everybody. They want it now. And you're like, wow, I don't think I can serve your account, not because we're not qualified, but I think we have to be aligned in the expectation. So I think one of the key things about a strategist like your firm is that you're entering a ball game that's in full play. All your clients are busy. All your professionals are busy. Everybody's moving 100 miles an hour. And if I want to jump into your world and ask you for that strategy, that tax preparation, that professionalism, I have to realize I got to get onboarded. Your firm has to learn who I am and what kind of complex return I have and how I manage my money. And that takes time. It's like any relationship. So the advice I'd give any of the listeners is when you get a really good firm like Thomas has, and you get a great opportunity for somebody who's made a true expertise at real estate, tangible assets, alternative assets, they get it, they understand it. You almost have to go, thank you for taking me as a client. Thank you for onboarding me, because there's very few good professionals. I think the 80-20 rule is really about a 95-5 rule. Truthfully, I've in 40 years of my career, I don't care if it's a lawyer, a CPA, a syndicator, a sponsor, oil and gas expert like myself, it's a 95-5 rule. There's 5% who are experts. There's another 15 who are 70% of experts, and the other 80% are disasters waiting to happen, who are just barely able to do the job you've hired for. That's just the reality in life, right? So my suggestion is, if you get hold of Thomas's firm and you want to be onboarded, I'd reference this podcast as the way you got there. I'd reference that, hey, I want to figure out how to onboard. I'm not jumping out of the building, but I want to figure out how I transition from my current CPA firm to your firm. What does that look like? Ask hard questions. Ask, what your bandwidth is, but also understand we're coming up on October 15th. They're all super swamped trying to get those last tax returns done. And as soon as they finish, they get about one turkey leg and a Christmas present. They're back at it again, preparing for April 15th. So there is only so much bandwidth, regardless of the intent of what you can do. You guys asked a ton of great questions on oil and gas. I might do a follow-up with Thomas about the questions, and we might do a Q&A strictly on oil and gas. We might do it in a hard copy or Q&A in written text, because out of respect for his time, I wanted to do this podcast for two reasons. He has been so kind and generous about highlighting Eckard and who we are, our mineral rights and our tax write-offs and our working interest, and really bringing out the substance of what that space is. I wanted to reciprocate by bringing out his expertise and how good his firm is recognized in the accounting world and what they do for their clients. And the second thing is, folks, I'm going to try to scare you a little bit, because I'm going to tell you, my personal view is whether Trump gets in or Harris gets in, we're all going to pay a hell of a lot more tax in the next decade, because we're broke as a country. And that means reduced deductions. That means switching deductions and alternatives and changing the IRS code to maximize the government's revenue, minimize our deductions, and find more ways to tax the income we make at every and all levels. A tax strategist today may be the most important investment any of us make for the next decade, because you don't want to work twice as hard to make half as much money. And I would say that if you don't find a strategist, you don't want to use Thomas and his firm, you better find that strategist, because I can assure you we're all going to pay a tremendous amount of taxes. Thomas, there's 3 minutes left. I'll let you wrap it up if you want to, and tell anybody anything you want about your firm or why they should contact you or how you want to leave the conversation.
Absolutely. And thanks again for having me on. It's been awesome to be on here today with you. So if you want to get in touch with us, we are tax strategists, and we also do prepare tax returns, but we want to focus on helping people reduce their taxes, which is why we lead with tax strategy and planning as our primary offering of how we help clients. If you want to learn more about that, you can go to the realestatecpa.com/Thomas. You can request a free 30-minute discovery call. And if you are looking for a new CPA, if you do want someone to help you be able to reduce your taxes, we'd love to learn more about you and how we can help. So you can find out there. We also have a podcast, and Troy's been on the podcast in a few episodes. It's the TaxSmartREI podcast, where we cover tax strategies for real estate investors, business owners, and individuals. And oftentimes we do cover alternative asset investment strategies and stuff like that, because it's so tangential and so around the real estate the real estate world. So if you do want to check that out, that's out on Spotify, Apple, and YouTube, wherever else podcasts can be found. That's a TaxSmartREI podcast. And last but not least, I would say that we are getting into the year end here. After 9/15, after everybody files their partnership returns, people will be looking to start. It happens every year like clockwork. People will be looking to start year end tax planning. So if you are looking to start year end tax planning, the best time to that conversation started is now, just so that you have someone to speak to about it. So if that's something you're looking to do, I would suggest doing that sooner rather than later, simply because things do get pretty busy as the year kind of gets into that Q4. So.
Well, I will tell you this. I would imagine CPAs are like my lawyer, because based on his billing hours, he's about 800 years old. But I would imagine that CPAs are kind of in a tougher boat, because you can't sit out by the waterfall like my lawyer does and think about me for 10 minutes and bill me for an hour. You got to physically crunch numbers and debits and credits and work. So I would say that there is only so many hours in a day, no matter how good a firm you have or how many professionals. There's so many hours for each professional, each expert, and each senior partner in your firm. So truthfully, the sooner that these attendees and listeners and those who follow the podcast recognize there's a shrinking amount of available expertise. Forget artificial intelligence. Artificial intelligence might help you with tax preparation. Strategy is going to go far beyond what AI can do, because it takes in a lot of things like emotions and risk, et cetera. So I think as you see more and more strategists retire, that network of strategies is going to diminish. And that means there's going to be less and less true expertise in Thomas's world. So I highly recommend you contact him, even if it's more than just asking questions, but let him help you decide whether you need a strategist or not. You may think you do and you don't, or vice versa. And I just want to tell you, Thomas, thanks for always taking the time to be on. Love to have you back in about 60 or 90 days, and we might tear into some real specific issues. But I bet you, if we have our little conversation after the election, it should be a hell of an interesting podcast, finding out once whoever's elected is elected, what we're faced with, because it is so polar opposite in direction. It's either you're jumping out of an airplane or you're landing in a soft pillow, but it's not going to be A or B. It's going to be A and B to the extreme is what I think we're facing. But again, always great to talk to you. Good seeing you, my friend. I hope you have a great end of the summer and Labor Day. For all you that attended today, we will have the recording. We'll send it out, and Derek Long will make sure that goes out to all the attendees. Don Pendleton, thanks to you and your group for all your participation and help. And we look forward to having another one of these in about the election.
All right.
Thanks Thomas. We'll see you, buddy.
Thank you. Bye now.